The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
That U.S.-China trade truce propelling the market to one of its best weeks of the year. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. An eventful Friday, given the data that we got. So let's check on where markets stand at the moment. We are at session highs with the S&P 500 erasing its earlier loss to gain for a fifth straight day, now up 0.5%, and for the week up about 5.2%. Small caps are the outperformers here, with the Russell 2000 gaining almost 0.9%. What's interesting here is that healthcare is the leading gainers within the Russell 2000 and the S&P 500, while energy stocks are the laggards. Once again, both in the small and big cap space. Not a whole lot of movement in treasuries. You can see the 2-year yield inching up by 1 basis point to 3.97%. And the Bloomberg dollar index, though the gain is fairly modest, the gain is pretty broad because the U.S. dollar is stronger versus almost all of the G10 currencies right now. Romaine.
Yeah, modest moves on the dollar, modest moves in treasury, modest moves in stocks, but that really does belie what was a monster week. And it's kind of hard to believe that today marks a halfway point in the second quarter. A quarter, of course, that began with the biggest U.S. equity drawdown in more than 2 years, which in turn flipped into one of the biggest relief rallies in more than 4. But Morgan Stanley CIO Lisa Shallett this morning saying that the run-up hard to justify, and she urged clients to take profits, at least on tech stocks, as in her words, the rally may be set to stall. So when you look at some of the restrained price action that we've had over the past few hours, maybe it is a hat tip to that notion. And maybe, well, it is tied to the latest round of economic survey data. The University of Michigan researchers today said consumer sentiment fell to the second lowest level on record, and inflation expectations, that rose to the highest since 1981, more than 7%, which is an astonishing number given actual headline inflation right now is below 3%.
Inflation has been the major factor for the last few years that has kept sentiment relatively low. And really the big worrisome thing for the future is that unlike the last few years after the pandemic in which people kept spending because their incomes were strong, consumers are really worried that labor markets are going to weaken.
And I just want to point out, too, that the only times in history where inflation has actually surged that much in a year's time frame has been in periods of extreme economic stress, like the global financial crisis or the COVID pandemic. But perceptions and expectations, they do matter because they could impact corporate bottom lines if consumers decide to retrench based on those perceptions. Target, Home Depot, TJX, Ralph Lauren, they're among some of the notable retail names set to report earnings in the week ahead. And analysts right now are expecting shrinking same-store sales, Scarlett, amid a lot of that tariff-fueled economic anxiety.
Yeah, and of course, we'll bring you those results when they cross next week. But inflation is very much at the heart of that tariff-driven anxiety. Here's a University of Michigan survey on consumers' expectations, Romaine, that you had mentioned. This is for inflation over the long term. That's the top panel. And inflation over the shorter term. Now, for the top panel, we're looking at 4.6%. That is the highest since George H.W. Bush was in office. And over the next year, the bottom panel, inflation expectations surged to 7.3%. That is the highest since the start of the first Reagan administration. So even though there's this temporary reduction in China tariffs, that pause is not doing much to convince consumers that they can plan effectively in the future and for the future.
And of course, that is the big bugaboo right now as we kick you off to the close here on this Friday afternoon. Carol Schleif joins us, Chief Market Strategist at BMO Private Wealth. And Carol, when we talk about investor sentiment, I'm wondering if that is in line with some of the dour consumer sentiment, or is it okay to have that bifurcation?
Well, it is interesting because clearly investors are in a different mindset this week than consumers and even actually than some of the businesses are. But clearly, investors like the fact that we've put some framework around the U.S.-China trade war, trade tip, whatever terminology you want to use for it. We've put some framework around that, and they put communication channels in line, and that's very positive, obviously teed the markets up. A lot of times, though, as we've seen, and as Chair Powell even has said a number of times, the sentiment data don't always translate through into the economic data. The sentiment data we saw this week is backward looking and it was pre-Monday's announcements that the markets were able to respond to. You haven't seen the ability for consumers to be able to respond to that. but they're hearing that constant drumbeat of headlines telling them inflation, inflation, inflation. And companies haven't necessarily figured out how or where they're passing it along. Even when Walmart announces in its quarterly results that price increases are likely pending, it doesn't mean across the board on everything. They'll likely be selective in where they do it. And so the impact, if it does or when it does come through to consumers, may end up being mitigated some.
I am curious, though, too, when we talk about the repositioning in this market, and obviously we've seen this big rally over the past few weeks, and it has been relatively broad. It wasn't just big tech leading the charge. You saw a lot of sort of real economy names, if you will, industrial names play into it. There's been a lot of talk about the attention that the White House is now going to put on the budget, on tax cuts, deregulation, a lot of the sort of quote unquote positive things that the president had campaigned on. And I am curious that if we do get those, and they are successful, is there a sense here that the market could rally on that? And if so, what parts of the market would most benefit?
Whether or not the market rallies further on that, if the market can sustain the rally we've had, because you have seen staying power with this rally. You had that huge, powerful rally on Monday. And the fact that it carried through for a few days tells you that that investors are tired of being dour, even though it was a pretty short time frame that we pulled markets back, and are looking for that positive announcement. I was at a great business event last night where we were celebrating the 500 largest Latino companies and talking to a lot of business managers, asking them specifically, would this be beneficial for you, having these sorts of regulatory relief come through and immediate expensing of R&D and things like that. And to the person, they were very positive that would have some immediate impact, at least on helping mitigate some of the potential impact they're already seeing from tariffs. So I do think when you get it rolled down, particularly in small and medium-sized businesses who are, after all, the bulk of they employ the bulk of the individuals in the United States. They're 80 or 90% of employment. Right. So if we get them stabilized and employment stabilized, that'll help.
Carol, as the chief market strategist of a private wealth firm, you serve affluent individuals, families, family offices. What are your clients saying to you? What are they doing during this 90-day reprieve that buys everyone a little bit of time, gives them a little bit of breathing room, but doesn't necessarily clarify what's next?
I think the interesting thing is we've always advocated diversified portfolios, and that's been a tough position when the primary market that was doing anything were U.S. stocks for a very long period of time. So to advocate for global diversification was tougher, but that's really worked, because the other thing that we don't want to lose sight of is not only did the U.S. markets rally this week, other bourses rallied as well. And you've got lots of the U.S. is back to flattish for the year when other bourses are up high single digits, high double, or 16, 18%, depending on what part of the world. So globally diversified is important. They've stayed pretty steady through that. The fixed income has been, by and large, provided that ballast that it should. We've had non-correlated assets in there like catastrophe bonds and some other things. So they're sitting pretty steady.
All right, good stuff. Carol, really appreciate your joining us today as we kick you off to the countdown to the closing bell, Chief Market Strategist at BMO Private Wealth. Coming up on the close, a deep dive into today's stunning inflation expectations with JPMorgan's head of U.S. inflation strategy, Phoebe White. This is the close. According to the University of Michigan, U.S. consumer sentiment falling to the second lowest level on record, while inflation expectations have climbed to multi-decade highs. Here now to discuss is Phoebe White, head of U.S. inflation strategy at JPMorgan. So Phoebe, I want to focus, of course, on the inflation expectations. What does it indicate that reported inflation is coming in tamer than expected? You look at CPI and PPI, yet consumers' perception of inflation continues to outstrip estimates.
Well, I think it's been difficult to, separate the noise and signal from that University of Michigan survey for some time now. I think if you dig within it, you can see there's been this historic divergence between, for example, inflation expectations among Republicans versus Democrats, right? So I think there's a bit of noise still in that signal. And I think partly for that reason, the Fed has been very focused on not just survey-based inflation expectations, but also market-based inflation expectations. And there we're actually seeing a very different signal. Following the Liberation Day tariff announcement, we actually saw market-based longer-run inflation expectations move lower, not higher. I think longer-run inflation expectations have been very sensitive to medium-term growth expectations. And so to the extent that we are facing higher tariffs, we could have a bit of a stagflationary episode here in 2025. But the outlook beyond that has been more about growth.
So I like that reference to this disconnect between consumers' expectations of inflation and market-based measures of inflation expectations. Do market-based expectations of inflation have a better track record than what consumers think?
Yes, I think, overall, it's been more sensitive to actual incoming data and kind of, incremental news and what we're learning on the tariff front. Right now, 10-year TIPS break-evens, for example, are trading at 235. Remember, TIPS break-evens are based on CPI, and CPI inflation tends to run a bit above PCE inflation. So based on that, we look at TIPS break-evens, and they're still very consistent with the Fed's longer-run 2% PCE inflation target. It's still consistent with well-anchored inflation expectations. I think what we've seen through this episode, again, with the tariff shock, more of the volatility has been really around the one-year part of the curve. One-year CPI inflation based on the markets is still priced around 320 or so. So priced for still an acceleration here in inflation over the coming months. But the idea that much of this tariff-driven inflation will be more transitory and that it should subside thereafter.
What about potential inflationary policies elsewhere? There's been a lot of talk about the budget and tax bills trying to work their way through Congress right now. Several of the more fiscally conservative Republicans have pushed back on that, largely, at least in their view, because they are concerned about how much it might add to the deficit and, of course, hurt the economy. Are you starting to see that being priced into the market, or is it too early to see that?
Right. So I think market focus is starting to shift a bit, and I think this is consistent with what Scott Bessent, for example, has been pushing in terms of this idea of sequencing, right? The administration came out first and foremost focused on trade policy, but now the administration is very focused on getting the tax bill across the line and also very focused on deregulation. So to the extent that we've sort of passed peak tariff hawkishness from the administration and market focus can turn more to potentially some of the more pro-growth policies that should help push longer run inflation expectations higher somewhat based on that kind of growth channel. So we are seeing that. And as I mentioned, longer run inflation expectations fell after that Liberation Day announcement. But from the lows, we have seen this recovery. So we are, pricing inflation expectations back towards the middle of the one-year range, closer to longer run averages. I think for those inflation expectations to continue higher, we would need to see more progress on that tax bill, getting through the House and through the Senate. If we see that get across the line, I think there is more room for those market-based inflation expectations to move higher. I think what's been interesting is I think a lot of that has been priced into the nominal yield curve, but those longer run inflation expectations have actually lagged.
Well, and that's what I'm curious about, too, when we talk about what's being priced in on in longer duration here. It does appear to be that you have a lot of folks sitting on the sidelines when it comes to longer duration, maybe because they are concerned about some of the potential structural issues when it comes to the deficit, the budget, and how that feeds through into the market.
Right. So we have been spending a lot of time trying to figure out what exactly this tax bill could mean for the Treasury curve. And I think we are looking at a broad curve that is substantially steeper than where it was just a few months ago. I think it is related to this idea of term premium, which is not just based on issuance expectations and the idea that deficits are likely to stay structurally higher, but also that a lot of the more structural buyers of the Treasury market have stepped away. Foreign official demand has been coming down over recent years. I don't think that's, an April 2025 story. I think that's an ongoing trend, and that's concerning for the market. But again, I think that term premium has risen already along the curve. Right now, we look at duration positioning based on our Treasury client survey, for example. That positioning was very stretched to the long side in early April, right after that Liberation Day announcement. I think some of those unwinds actually contributed to the move higher in April.
Sorry, when you say the term premium, you're talking about on the 10-year or on the longer duration stuff, that the term premium has increased?
So I think term premium, as it goes up and down, actually does drive the whole shape of the curve. So we typically look at it around the 10-year point. But as term premium heads higher and pushes that 10-year Treasury yield higher, we see a steepening in the broad yield curve as well.
Phoebe, in terms of the data that we did get this week, CPI, PPI, and now the inflation expectations, is this enough to shift forward investors' perceptions of Treasuries?
So I think that investors should be careful to take too much signal from the softer inflation data this week. We have been saying for some time that the tariff impact was likely to show up a bit further out, so with a peak impact probably around June, July. Remember, we did see a lot of inventory building even through last month, and I think that's allowed firms to kind of push off the timing of when they've needed to implement those price increases. On top of that, we saw from the PPI report yesterday a very large contraction in that trade services component of the report, referring to a compression in firms' margins. So for now, firms are delaying the timing of when they need to push up those prices, but I think it is coming. I think we will see an acceleration here in inflation over the next few months.
All right, Phoebe. Phoebe White, head of U.S. inflation strategy over at JPMorgan. A closer look at what's going on in the markets on the back, of course, of that University of Michigan consumer sentiment report that's having a bit of an impact here on pricing in the bond market, not necessarily on equities. And when we come back, we are going to talk a little bit more about equities and one of the best performing stocks over the last few weeks, Netflix. David Joyce, senior analyst over at Seaport Research Partners, joins us in just a second. This is The Close on Bloomberg. All right, let's get right to our top calls. Big movers on the back of analyst recommendations. And we start off today with Carnival. HSBC, which has had a sell equivalent rating on the cruise line operator since 2020, upgrading today to hold. HSBC said its key concern in its previous bear case has been addressed as Carnival has deleveraged and says the company could do better in a serious economic downturn relative to its peers. Those shares up for a second straight day, up about 2% here. All right, next up, Caterpillar. UBS upgrading to neutral from sell and lifting its price target by more than $80 to $357. The firm says that the easing of trade tensions between the U.S. and China helping to contain the downside scenario for the equipment maker. Those shares up about 1% and about 9% on a weekly basis. Best weekly performance for that stock since early January. Meanwhile, to the flip side, let's take a look at Meta. Loop Capital did raise its price target from $695 to $888. That's the third highest target on the street. Despite the reports yesterday that Meta's behemoth AI model is delayed, Loop says it's confident in the company's advancements in that space and that it will outperform its Mag 7 peers this year. Nevertheless, Meta shares down for a second straight day, lagging its peers on the day, and those are some of our top calls. We're also keeping an eye on another interesting call involving Netflix, one of the surprising outperformers over the last few weeks. That stock at a record high today as the video streamer gets a price target raised to $12.30 from $10.60 over at Seaport Research. In the wake of Netflix's upfront advertiser event, the analyst is reiterating his buy rating, saying he believes the stock should remain a core holding and has proven its recession resilience during the recent market turbulence. Pleased to say that the man behind that call joins us right now. David Joyce over at Seaport Research joins us right now. All right, David, this was kind of one of the stealth rallies. I remember like a couple of weeks ago, someone pointed it out to me, and I was actually kind of surprised. Not only has it rallied a lot, but it never really saw the same type of drawdowns that we saw in some of the broader tech and discretionary space back in April.
It's interesting that this went from a growth story to being a very resilient story. It was one of the few stocks that stayed up during the tariff tantrum because people's opinion shifted to the side of, well, if the recession comes, the consumer needs some form of cheap entertainment, and at these price points, $17, $18, or even if you look at the ad version, it's $7. It's pennies a day for a month of entertainment. So that's, I think, really how the sentiment really moved on this name during that troublesome period in the spring.
Right. The idea that Netflix is kind of like a utility for so many of us, the way that our cable TV packages were utilities. How much pricing power does Netflix have when it comes to the ad-supported tier? You mentioned how it's cheaper, obviously, than the premium package, but at the same time, if consumers are expecting prices to go up overall, and we saw that with the University of Michigan numbers, I would imagine that they do have some levers to pull.
Right. So one of the things that also helped the stock along these lines is some information that leaked on the company's aspirations, possibly in 2030, which really would indicate, if you're going to try to backfill to those, that the company expects that they can continue to lift prices. And they tend to do it every year, but on a rotating basis on different markets, because they do continue to add more content and more originals, and the viewership is still remaining very strong on these. On the ad tier, they expect that it would probably take 2 to 3 years to kind of neutralize what they get from that consumer who's on the cheaper ad tier, plus the advertising revenue they generate, compared to the subscription-only subscriber. But they're still just in the very early stages, very early innings on the ad tiers. So there's definitely room for them to grow.
Is there a sense here, though, and we talk about their room to grow here, is competition not as much of a factor? I mean, I remember whenever it was 3 or 4 years ago when all these new streaming services were starting, everyone was saying, okay, potentially they could eat Netflix's lunch. Where do we stand right now, 4 or 5 years later?
Well, the thing that benefits Netflix is that their platform is the most globally distributed. Disney Plus is in a pretty similar situation, but Netflix really does have content for everybody. It's a go-to. It has a lot of local content, which drives up the local viewership around the globe, but that also provides content that can be distributed into other markets around the globe, and that lifts their margins. So I think that that platform around the globe helps to drive this, and it's still the first place that people look when they can't think of what they want to watch.
Yeah, absolutely. I mean, that's the case in most households. David, really appreciate your joining us today. David Joyce is Senior Analyst over at Seaport Research Partners. Thank you so much. And of course, another thing that we didn't get a chance to talk about until now is Charter agreeing to combine with Cox in this $34.5 billion deal. This is something that they had talked about in the past, about 10 years ago, but never pulled the trigger on it.
Yeah, I mean, this almost seems a little bit maybe of, I don't want to call it desperate, but certainly at a point now where maybe they find out maybe trying to scale up can help save them. But there's also a bigger issue here, too, which is how do you reshape what cable TV is, what satellite TV is, in a world where we are just streaming everything on Netflix? Well,
you're managing declines, essentially. Yeah. All right, well, coming up, we're going to speak with the CEO and founder of Bogg, Kim Vaccarella, about how her company is navigating the tariff uncertainty because she relies on manufacturing in China. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu, and we are on our way to the second biggest weekly gain of 2025 because at the start of the week, investors woke up to the news that we have a reprieve on the China tariffs for 90 days.
Yeah, we got that news on Sunday, and it gives us a sense here that maybe the worst case scenario that was being priced into this market just a few weeks ago, that might be off the table now. We should point out the tariffs are still there.
Absolutely.
The tariffs are much higher than where they were 4 months ago, but not necessarily the 145% tariffs, as a guest earlier this week pointed out, basically means There's no trade happening.
Absolutely. So now you have some trade as opposed to no trade. So it's only 90 days, but the steepest of those China tariffs have been put on hold. Companies like Bogg are restarting their production in China. Let's bring in now, right now, Kim Vaccarella. She is the founder and CEO of Bogg, which is the perforated tote bags that have become extremely popular with soccer moms and nurses. Kim, thank you for joining us once again, as always. As I mentioned, you're one of the companies moving pretty quickly to restart production now that there is this 90-day reprieve. So I'd like to hear what that looks like for you. Can you give us a sense of, for instance, how many bags the factories can make for you? How many can make it onto the container ships? How many can get unloaded at U.S. ports during this time?
Yeah, it's kind of still, everything's still all up in the air, even though we started production again to try and salvage our fall and holiday season. There's so many things pending right now. So we did go into full production. We think we're good on that end. We've been working with the factory, making sure that they can kind of catch up for us. So production is not an issue. Having said that, while we still are looking at Vietnam and, an alternative manufacturing, we have gone back to China for the time being. And we'll see what happens when we start to put containers on the water, because I'm sure a lot of people are doing the same.
Absolutely. So I want to follow that thread. What do shipping costs look like right now? And how's that negotiation going?
So shipping costs right now look normal. But I'm afraid of the COVID shipping, where containers that cost $3,500 shot up to $28,000. I don't think that we'll get there, but as everybody's trying to bring in their fall and holiday product, you're going to see those rates spike. Because looking at the live feed at the Shenzhen port, there were no trucks going in and out of there. Now it's going to get busier again. So with that, it's going to come the congestion pricing.
This gets to this issue, though, Kim. If we talk about the inflationary pressures here, and if everyone is trying to sort of, front load, or middle load at this point, everything into the U.S. before you get to this end of the 90 days here, are you worried at all that you might end up overpaying for something that maybe if you had waited 3 months or however much longer is left in this 90-day period, you wouldn't have had to pay for?
Well, obviously that thought came into process many times when trying to decide what to do. I would rather be able to supply our customers and our retailers with product than to not. The decision was easy there. Let's move forward. We did cut down a little bit on what we were ordering or the pending POs that we had in place, just to streamline a little bit more and make it a little bit easier across the board. But we wanted to have the product.
Have you had any real serious discussions about maybe tweaking the prices to account for the increased costs?
We've had multiple discussions. I think since the last time we spoke, we were going to put in a price increase in April. We ended up clawing back on that. We said, you know what, there's too much chaos going on. There's too much to figure out. We still don't know where, at this point, don't even know where the tariffs are going to end up. So let's revisit that at a later date. So right now, the emphasis is on getting the product into the warehouse.
What about your product lineup in terms of how many different products you are offering? I mean, right now you're planning for your fall and your holiday selections. I understand you're planning to cut that down. Is this something that affects your customers directly, meaning were these products that stores had already ordered and now need to be told are not available?
Some of them, yes. And what we did was we took a very methodical approach to it between our leadership, our sales team, and then just pure data. What were the top sellers in those areas, and what were, maybe we loved it from a design perspective, but maybe it just wasn't sitting up there at the top. Let's give them the winners. Let's give them all winners. They're struggling as much as we're struggling. So let's make sure we have what they need to really have a great holiday season.
If Beijing and Washington don't make enough progress on trade talks during this 90-day window and then need to extend this pause once again, kick the can down the road, what kind of window would work better for you? If you could lobby for a certain window, what would it be?
That's a tough question, Scarlett. I mean, I don't know. We've been so up in the air for 4 months, 5 months now. How about no time frame? How about no tariffs? I mean, that would be the best case scenario. But right now, I'm just going to, we're going to do what we can with the 90 days. Let's hope after the 90 days that there's some good news there. And if they keep it at 30, at least we can plan. Right now, it's been so difficult to reforecast, plan, reforecast again, plan. It's too much to do.
Long term, when you talk about your supply chain and where it might be located, how diversified do you think you can ensure Bogg is? Or conversely, is there an opportunity to actually try to reshore some of that production?
Well, I've been working with the same factory for 10 years. So we've had all of our eggs in the China basket and in one factory's basket for a very, very long time. So this has really forced us, between the tariffs and then just reassessing and resetting, that we do need to diversify for more reason than just the tariffs. So we will continue to have those conversations. We're sampling right now at multiple factories, just so that we make sure, in the event that something else surprises us over the next year or so, that we have some options available to us.
Kim, final question to you. This has been obviously weeks of confusion and frustration for you. Is there anything that came out of this that was unexpectedly good? Things that have surprised you on the upside?
Well, I think there's always opportunity when these things happen. There were opportunities over COVID. We're looking for those opportunities. Again, I keep saying the word reset. There's a way to go back and look at everything, see where we're spending too much money. How can we mitigate some of our risks? Let's reevaluate everything. Now is the perfect time to do that.
All right, Kim, well, we wish you well, and we'll catch up with you again soon, I'm sure. Kim Vaccarella is the founder and CEO of Bogg, and of course, this was a week where we did start off here with that, I guess, trade truce, if you will, a détente, if you will, between the U.S. and China. But of course, we end the week with still some pretty pressing concerns when it comes to what's going on in the government and what's going on in the economy. Traders sorting it out, but nevertheless, the net effect of it all is the S&P 500 sitting on a gain on the week of about 5%. Not participating in that rally is Novo Nordic. Those shares actually down today on the surprise news that their CEO is being bumped out. We're going to take a closer look at the reasoning behind the move in our Stock of the Hour. This is Bloomberg. Our shares of Novo Nordisk are down. You're taking a look. I believe those are the ADRs, down about 2% here in the U.S. after the surprise departure of the CEO, Lars Jorgensen. The company said in a statement that the decision came after considering the recent market challenges and the share price decline. A search for a successor is now underway. Joining us right now to talk a little bit more about this is Madison Muller. All right, Madison, just to set the scene here. Ozempic, Wegovy, probably two of the most blockbuster drugs we've had in a generation. Tens of billions of dollars in added revenue to this company. Yeah. But there are a lot of concerns that they didn't necessarily capitalize on this big boom to take it to the next level. Exactly. Now you got Lilly and all these other companies nipping at their heels. Is this an issue with Novo's strategy, or is this an issue with the way that the CEO was executing that strategy?
Yeah, I mean, that is a really good question, because when you look at what Lars has done for Novo, I mean, like you said, he launched one of the biggest pharmaceutical products ever, one of the first pharmaceutical products to really become a household name in a long time. And Novo created this obesity market that we've been talking so much about. It might be, though, and I've talked to a couple of analysts who said, Novo, historically, they're an old company, but they haven't launched a blockbuster product like this, and they might have experienced some growing pains. I mean, they're a Copenhagen-centric business. They do have a presence in the U.S., obviously, and it's their biggest market for drugs, but to have a product explode like this and then sort of not really know what to do next and maybe squander that opportunity and not have, a pipeline chock full of next generation assets like some of their competitors do. Is that a strategy thing? Were they sort of relying and resting on their laurels with Ozempic and Wegovy and not looking toward the next thing? It's a question, but the company was emphasizing that the strategy is not changing.
But why such an abrupt change, though? Because usually if you're going to announce a change like this, it's usually going to be like, all right, Lars, thank you for your service, and here's the next person that's going to take over. They hadn't even started a search for a new CEO.
Right, and Lars is going to be sticking around until they find the next person, which is also interesting. I mean, they're saying you're out, but you have to help us kind of get through this time still. And I think it shows a little bit of the urgency and the pressure that this company is feeling, that they had to do something. They had to announce some type of change, but they didn't say that they're changing the strategy. They're just changing the person in charge. And the reaction, I think, from the business community today and also from employees at Novo Nordisk was very telling. People were upset by this, like personally really hurt and sad by the departure of this CEO, who is seen as a very even-keeled, level-headed, humble business leader. And some of the Danish business community, my entire LinkedIn feed today was people writing these long posts about how great Lars is and how amazing he's been for Europe and for Danish business, all of these things. And people were really taken by surprise, I think,
today.
Who made
this decision here for Novo Nordisk? Because unlike American companies, European companies don't tend to have the same CEO and chairman, right? I mean, Lars was the CEO, but there's someone else as chairman, and there was a foundation that was involved here in this decision.
Yeah, so it sounds like it was actually coming from the Novo Nordisk Foundation, which is the controlling shareholder in Novo Nordisk, the company, and that was a decision coming from the chairman of that foundation. And so it's an interesting dynamic. Actually, their main competitor, Eli Lilly, has a similar setup with the Lilly Endowment, which is now the biggest private nonprofit in the United States as of today. They just surpassed Gates, which is kind of interesting. We have another story on the terminal about that. But they are the biggest shareholder in Eli Lilly, the company. They own 10% of the company's shares. So they don't have the same type of relationship, like, you know, the endowment couldn't really come in probably and push out Dave Ricks. But it's sort of an interesting dynamic that we don't see typically with American companies.
I hope he has a good non-compete clause, because I think somebody, I mean, he's still pretty young, right? He's in his 50s.
He's 58.
I was just looking.
He's very young.
So, yeah. We can see how this plays out.
Yeah. Madison Muller, thank you so much. Madison Muller telling us more about Novo Nordisk abruptly replacing a CEO because of the Lilly rivalry. But again, there's no immediate replacement needed.
Lilly hired him, or one of the competitors.
Maybe he's pitching himself to Lilly. All right, coming up, we've got Richard Weiss, CIO of Multi-Asset Strategies at American Century Investments, counting us down to the closing bell.
I think that investors should be careful to take too much signal from the softer inflation data this week. We have been saying for some time that the tariff impact was likely to show up a bit further out, so with a peak impact probably around June, July. Remember, we did see a lot of inventory building even through last month, and I think that's allowed firms to kind of push off the timing of when they've needed to implement those price increases.
Phoebe White over at JPMorgan, kicking us off to the close just about 50 minutes ago. A closer look at some of the economic data this morning, having a bit of an impact in the bond market. Nevertheless, investors taking it in stride, certainly in the equities space, bidding up stocks here for yet another day. The S&P right now sitting on gains on a weekly basis of more than 5%.
Yeah, the second biggest weekly gain in 2025. So pretty incredible. But not so much if you think about the fact that we started this week with the Trump administration saying, well, you know what? We're going to put a 90-day reprieve on those China tariffs. We're going to bring them down to 30% and then try to figure things out from here. The VIX coming down to a 17 handle. That's compared with 60 on April 7th and the 3-month average of 24. Not much movement in the 10-year right now at 4.44%. And the dollar gaining against almost all the G10 currencies, but in aggregate, only a 0.2% gain.
And back to the equity markets here at that 59, 53 level. Keep an eye on some of those upside resistance levels, which are around that 6,000 mark here. A lot of the strategists that we had on earlier this week said that could be a next test. We should also point out that the rally today is broad-based in nature. About 90% of the stocks in the S&P 500 bidding up, and I guess in a relatively good sign, you are seeing a lot of non-big tech names leading that charge, at least on a percentage basis. So maybe that gives us a sense here that that there is maybe a little bit more legs to this, and this isn't just the Metas and Microsofts and Nvidias of the world.
Yeah, a broad-based advance, right?
Absolutely here. In fact, one of the biggest gainers on the day, believe it or not, is United Health, but that's more of a rebound rally.
Yeah.
But then you have Pfizer and Moderna, Supermicro, Humana, a lot of other names in there getting bids. Lamb Weston, you like French fries, don't you?
Love them.
Rich Weiss joining us right now is the CIO of multi-asset strategies at American Century Investments. Rich, I don't know how you feel about French fries, but Lamb Weston, the seventh biggest gainer in the S&P 500 right now. Is that the play right now? I am curious about this rebound rally in all seriousness and the idea of what we're rebounding into, because it's not necessarily people piling back into big tech. They do seem to be looking for something else.
Yeah, no question. This relief rally, if that's what you can call it, since the rollback of the trade policy, the more aggressive trade policy, has it's been fairly broad-based. But today, the same is true as what's true year to date, which is what's leading the market year to date and today. Defensive sectors, utilities, healthcare, consumer staples. So I wouldn't. It's certainly not a bull market, right? It's a relief rally, a rebound, and stocks now. Since Liberation Day, have basically done a full 360, right? Mm-hmm. They got punished in a few weeks afterwards, and now they've rebounded nicely. So we're back to where we started from with a whole bunch of volatility.
Does that mean you add risk?
We're not looking to do so. I'm taking this somewhere out of context. I guess Shakespeare, wasn't it? Discretion is the better part of valor. We're going to remain diversified. We're not plowing into the market at, PE levels in the mid 20s, especially when you have other markets around the world which are priced much more attractively with accommodative monetary policy. And, if the U.S. is able to steer clear of a recession, that means most likely so will the rest of the globe, and the prices there are much more attractive. So we're not taking on U.S. risk, that's for sure.
Well, everyone says the easy part of the stock market rebound has taken place and is probably behind us. So which asset class has that easy part of the rebound now rotated to?
Well, defensive stocks, I think, is a smart play in the U.S. stock market right now. I don't know that anybody disagrees with the fact that inflation will be rising here. Ms. White, your prior guest, stated that eloquently, and that growth will be slowing, right? So this is not an environment to plow into high beta stocks or small cap stocks, which are also pretty pricey. We'd go overseas. And also within fixed income, we're staying high quality, but we have more of a barbell strategy around duration. So picking up a nice healthy yield on the short end, but just in case hedging bets by going out longer, in case we do touch down below zero with a recession.
So last month it was all about tariffs and potential trade deals. With the reprieve this week, everyone's focus now shifts to the tax bill. And the president this morning put out a Truth Social post suggesting that the bill might be struggling a little bit in the House. How sensitive is fixed income to every social media posting from the president? Every comment out of the speaker?
Yeah, that so-called skinny reconciliation bill needs to go on Ozempic, okay? Needs to get a little skinnier, lose some weight. I mean, the fact is there's much too much in there. We're not in a position here in the U.S. to be adding trillions of dollars to the deficit, and I think everybody knows it. This was just the first shot at it, and nobody expected it to go through it. Although skinny bills typically do go through, but this one was a little heavy. So the bond market is going to definitely be keying in on this, both long and short end of the market. I mean, this is going to be the major driver now that hopefully the tariff issue is calmed down to some extent. But either way, again, inflation coming, growth slowing. It's a matter of duration and degree, right? Is it going to be transitory and minimal effect, or is it going to be more chronic and severe? And that's a question nobody can answer right now.
Are you worried about any sort of structural issues that may come out of this budgeting process and the effect on the bond market? I mean, we kind of joke about this skinny bill. By the way, I actually downloaded it and tried to read it. It's like 1,100 pages. I got to page 3 before I gave up. But it gets to this idea that there's clearly a big cohort in Congress that does actually want to extend these tax cuts and add trillions. And it's a very small number of conservative Republicans that want to block that and actually, deal with these budget issues. So who wins that tug of war?
Well, I think the president wins that one, which means, it's going to lean towards adding to the deficit. and the debt burden. And that's unfortunate. And so what does that mean? Long rates are going to stay where they are, or go even higher. I mean, if we already have inflationary pressures baked in the cake from the tariff program, and now you add to this, it could become eventually a credit issue for the U.S. And I wouldn't blame Fitch or the others to take another look at our credits if that's the case. It's surprising after all these years of the GOP, pushing in the other direction, that they would be the ones to expand the deficit. But hey, that's where we are today.
All right, Rich. Well, we got to leave it there. You didn't actually answer my question about the French fries. That wasn't rhetorical, by the way. So, Rich Weiss, always look great conversation. Have a wonderful weekend. CIO of Multi-Asset Strategies at American Century Investments, counting us down to the closing bells. Just about 2.5 minutes ago, with stocks holding near the highs of the day. 0.6% gain on the S&P 500. Similar gains for the other major indices.
Yeah, and for the week, don't forget the S&P 500 up by 5.25%. The Nasdaq gaining 7.1% on the week. Still only the best gain since April 11th.
A lot to break down here with yields moving higher on the day. Our global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here with Scarlett Fu, taking you through to that closing bell with a global simulcast. It started. Tim Senovic is in the radio booth. Emily Grafeo in today for Carol Massar. Alex Seal on assignment as we welcome our audiences across all of our Bloomberg platforms, including our partnership with YouTube, as we close out what has been, Tim Senovic, a very solid week for U.S. equities.
Yeah, one of the best weeks of the year for the S&P 500. We're solidly in the green on the S&P 500 year to date. And Emily reminding me a little earlier that we're up 19.5% from those April 8th lows on the S&P 500. So that was just like 5 weeks ago.
Right. And the market was still able to rally higher today, despite the fact that a lot of the economic data that we got showed consumer sentiment is pretty weak and Americans are expecting inflation to tick up higher.
Yeah, but so far that hasn't translated into the hard data showing that same kind of damage, right? So as long as that hasn't made that leap over, a lot of folks in the market are saying it's still time to sit back and see how it all plays out.
And it gets to this idea, though, too. I mean, when we talk about this rally, and I'm glad you brought up this, or Emily, you brought up this idea of this 19% rally off of that lows, of course, after having that effectively 19% drawdown from the highs on the S&P 500. We haven't round tripped just yet, but it is kind of interesting that this isn't necessarily being led by tech in the way that you would think it would be. It is a lot of the other sectors, right, Emily?
Yeah, I mean, that's right. If you look at the equal weight index, it's been rallying there as well. And also the Russell 2000 small caps outperforming both mega cap tech stocks and the S&P 500 today.
All right, well, on a weekly basis, tech is out front, as are the discretionary names, but all of the 11 S&P sectors in the green on a weekly basis. As for the day, you have the Dow Jones Industrial Average closing out up about about 328 points, or about 0.8%. The S&P 500 up more than 40 points, or 0.7%, while the Nasdaq higher by 100 points, or 0.5%. The Russell 2000 getting in on the action as well, adding about 19 points, or 0.9%. And we should point out transports and mid-caps also getting pretty strong bids on this day, up about 1% each.
This was a broad-based rally, at least in the S&P 500 today. You only had 56 names move lower, while you had 446 names advance on this Friday afternoon.
Yeah, so it's a pretty clear IMAP, too. Look at the 11 sectors in the S&P 500. Only one, energy, finishing lower by 0.2%. Otherwise, what's interesting here is that you have the defensive sectors, those that pay high dividends, healthcare, utilities, real estate investment trusts, and staples doing the best.
All right, let's go to some of the gainers on the day. An easy task to find these. I want to start with Charter Communications, up close to 2%. We could say 1.8%. The company has agreed to combine with Cox Communications. It's a cash and stock deal valued at about $34.5 billion. That does include debt. This combined company would be the top broadband operator in the U.S. It would increase Charter subscriber base by more than 20%. It would position them to better compete in this converging market where you have the wireless providers offering wireless service. You also have the wireless providers offering fixed broadband service as well. So it is a really competitive space. We just spoke to Craig Moffett over at MoffettNathanson. He reminded us the core product when it comes to TMT companies, it's no longer TV, it's no longer cable. This is all about broadband. Once again, shares of Charter today higher by 1.8%. CoreWeave finishing the day higher as well. 22% to the upside today. It more than doubled from its March IPO. This after NVIDIA reported its stake increased to about 7% of outstanding shares. This was as of March 31st. We learned this in a 13G filing on Thursday. NVIDIA was expected to have about a 5.2% stake in CoreWeave after its IPO. That was what the prospectus showed back at the end of March. And finally, look at what happened with Virgin Galactic today. Now, to be fair, the stock has been beat up over the last few years. Shares just soared today. It was up as much as 98% earlier in the session, closed higher by 43% to the upside, a record intraday gain. Analysts encouraged by the space company's first quarter results. They did say they plan to charge more for its space tourism flights when it resumes sales in the first quarter of 2026. They've got this new Delta spacecraft. It's going to hold 6 people, faster turnaround between missions. Then they'll clear this existing backlog of ticket holders in about a year. Also, they made about $460,000 for the first quarter. It was slightly above estimates. Negative free cash flow, though, expected to be between $105 million to $115 million in the second quarter, Emily.
All right, let's look at some of the decliners for the day. Applied Materials. This is a chip equipment maker. They gave a lackluster forecast for the current period, highlighting the potential cost of the U.S. trade dispute with China. So the company said sales will be about $7.2 billion in the third quarter, plus or minus $500 million. That was roughly in line with Wall Street estimates, but some analysts had projected as much as $7.4 billion. So that stock closed down about 5% today. I'm also watching shares of Hershey, the chocolate maker, was down 2.3%. Additionally, Mondelez was also falling as cocoa prices, which of course is a core ingredient in chocolate candy, surged to a 3-month high today on renewed supply fears as shipments from top grower Ivory Coast slow, and also dry weather threatens next season's output. So go and buy your chocolate right now, Romaine. Those shares were down 2.3%. And speaking of food, Cava was also down about 2.3% closing today. The fast casual chain reported first quarter results and updated their outlook, but analysts said that while the report was positive relative to peers, the dining establishment needed stronger results to justify the premium valuation. That stock is up a ton since going public in 2023.
All right, let's check in on yields here. Third straight week where we've seen yields rise, both on the 2-year and the 10-year. You see the numbers there. These are your daily moves. 3 basis points on the shorter end of the curve, not much on the longer end of the curve. But it should be pointed out, you go back to where we were in mid-April, towards the end of April, when yields were actually drifting lower. The big bump up ever since then, basically since the start of the month, certainly concerning. A flirt with 5%, of course, in the middle of the curve, in the longer end of the curve, and a flirt, of course, with 4% on the shorter end of the curve, 3.99 right now on your 2-year yield.
Okay. You know, this is a program that airs worldwide. We've got viewers and listeners all over, but our focus for part of the program today has been what's happening in the New York metropolitan area, given the strike, the first one in 40 years that we've seen. When it comes to New Jersey Transit, we spoke to Bill Maloney earlier, who typically takes him about 90 minutes to get in on the train. He had to drive to Hoboken from his home, walk from wherever he was able to park in Hoboken to get on the PATH train because he wasn't able to get on New Jersey Transit today. It's not just disrupting, though, people who are trying to get to and from Manhattan, from New Jersey for work. It's also going to disrupt Shakira fans who are attending the concert at MetLife Stadium tonight, and it happened even last night as well. Real hiccups.
You know, Tim, I feel like you usually expect that if you're living in New York or you're in the New York City metropolitan area, there's going to be a little bit of traffic trying to get to MetLife for a sports event or for a concert. But our Bloomberg News reporting sourced a tweet here. Someone tweeted that they sat in traffic for 6 hours for that Shakira concert, which that sounds like a lot more than you would typically expect. And
they better get this sorted out for the Beyonce concert next week. Beyonce starts her 5 concerts in the MetLife next week?
Yeah, the Beyonce concert, Shakira folks got stranded yesterday. I mean, I don't know if you're actually a basketball fan, but apparently the New York Knickerbockers, who have, of course, sucked wind for decades now, actually in contention. So how are all those fans who don't live in the city going to actually get here tonight? They're going to drive in?
They're going to zoom in?
They're going to drive in?
Yeah, do a shared Uber.
No, but it gets to this idea too. I mean, and I know a little bit earlier on this program, we had some of the officials on this network. I should say we had some of these officials on. This doesn't seem like they're anywhere close to striking a deal. So I do wonder how long this goes and sort of how we sort of mitigate the impact.
Well, a lot of people are getting ready to work from home, perhaps. But, what's interesting is that in the markets, working from home on Fridays may no longer be something you can do because trading on Fridays has become a lot busier. For portfolio managers, it's become the busiest day of the week because they need to prepare their portfolios for what could be market-moving news from President Trump over the weekend. They are de-risking their portfolios, in many cases buying treasuries and selling credit.
Yeah, and I mean, more importantly, though, this is also about the price action as well. I mean, there was always sort of this churn, and this is specifically when we're talking about the fixed income space, was typically you can buy things relatively on the cheap on a Friday and then roll that over into next week. And now that's kind of been upended. So a lot of folks are basically working a lot longer and a lot harder and a lot later on Friday to sort of set themselves up and prepare themselves for maybe what happens over the weekend.
May I make a humble suggestion? No. To our investing audience.
What's that?
Perhaps maybe just buy another Bloomberg terminal for the vacation home. There
you go.
The place in the Hamptons.
You have no vested interest here.
Always
I would
selling.
suggest maybe that would help with this challenge of just always having the information, at the ready. So you can enjoy a 3-day weekend perhaps, but also be able to act on that info.
All right.
It's just a humble suggestion, guys.
I think our bosses love you, Tim.
Oh, well.
Yeah.
That's the idea.
And this is why.
Hey, guys, that is going to do it. Have a great weekend, everyone.
You too.
I think the band is getting back together next week. I do want to thank all of you. It is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and Bloomberg Originals. We will be back on Monday, same time, same place.
And our coverage continues right here on Bloomberg Television. The next few weeks could prove to be a big test for macro risks, specifically out of Washington, D.C., as the budget battle ramps up. Kim Wallace of 22V Research is joining us in just a second. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romaine Bostick as we close out a monster week for U.S. equity markets. In S&P 500, they gained about 0.7% on the day, but up a whopping 5.3% on the week. Similar moves for some of the other major indices, including a 5% weekly gain for the Russell 2000, a 7% gain for the NASDAQ Composite, and a 3.5% gain for the Dow Jones Industrial Average. The Mag 7 getting their mojo back here, rallying about 9% on a weekly basis, but we should also point out industrial stocks getting in on the action as well, up for a fourth straight week. Interesting, though, to see the flip-flop that we're seeing in gold back down to that 3,200 level, down about 1%. In fact, it's now down at some point, I think it was down about 7% from that big record that we hit just about a week and a half ago back on May 6th. And you see your 2-year yield moving slightly higher here, flirting once again with that 4% level. As far as some of the individual movers go here on the day, it's kind of intriguing to see the stocks that are being bought. At the top of your screen, that's the bank, BNY. And why do I bring that up? Of all of the stocks in the S&P 500, of all of the stocks in the Russell 1000, no stock has had a daily win streak like BNY. That stock right now on a 15-day run, the longest in history, up more than 20% over that stretch. Meanwhile, Netflix adding about 1% to close out at a record high. And of course, next week is going to turn a lot of attention to what's going on in the retail and apparel space. We get a lot of big names reporting, including Ralph Lauren, Home Depot, as well as TJX and Target. And that brings us to our top story of the hour, and that is the second leg of the three-legged stool of White House economic policy. As the trade war rhetoric gets dialed down from an 11 on the amp, investor attention is now turning to the tax and budget proposals that are trying to work their way through Congress. Unfortunately, that budget reconciliation bill appears to have hit a wall. 5 Republicans who balked at the legislation's front-loaded tax cuts and back-loaded spending reductions joined Democrats on the House Budget Committee today to block that bill. That just happened about 4 hours ago. Now, keep in mind, it's incredibly rare for a bill like this to fail in committee, particularly bills of this size and importance. The partisan budget bill, which does include an increase to the Treasury debt limit, was part of a plan to finance an extension of those tax cuts approved during Trump's first term in 2017. It's not immediately clear right now how House Republicans will regroup to address these divisions, but the president, of course, is weighing in on his social media platform, telling his party to unite and get it done. Kim Wallace joins us right now, head of Washington policy research at 22V Research. And I am curious if they can get it done, because when I look at those 5 Republicans and I look at why they voted against the bill, Kim, these seem to be some pretty big sticking points. We're talking about cuts to things like Medicaid and Medicare, other sort of fiscal belt tightening that it doesn't really is not really clear that the rest of Congress is on board with.
Romaine, that's true. And these five in particular, their biggest concern isn't that all the Medicaid cuts and other spending cuts that some Republicans think are too deep and others think are not deep enough. These people simply think that the deficit, annual growth of deficits and the accumulation of debt is too much, and they're putting their foot down to say enough is enough.
How much power, though, do they have? Because we've seen this before where you've had Republicans splinter off. And then, of course, the president, particularly in his first term, he would sort of call them up and make it clear that, you're going to do this or else. And I'm wondering if the president has that kind of leverage and impetus to do that again this time.
Well, that's the question. After months of trade uncertainty and the impact of trade uncertainty, along with a few other items that the president has done, particularly the activities of Elon Musk in the first quarter, clearly the president's political capital has diminished. Whether or not it's diminished beyond the point that he can fix this bill, we'll find out. Budget Committee Chairman Arrington in the House has said his panel will reconvene on Sunday. I'm not sure the calendar matters as much as the substance that's in the legislation and the growth of red ink. In the first half of this fiscal year, the deficit is on a 15% year-over-year increase. It's more than some members, particularly in the House Republican Caucus Conference, are willing to put up with.
Yeah, I am curious. What is? I'm going to put this delicately. Is this all about the extension of those tax cuts? If it wasn't for the extension of the 2017 tax cuts, do you think that this bill would be as contentious as it is when it comes to those budget and deficit issues?
No, because you wouldn't need as much money. Whether you look at this on a 5-year or 10-year period, over 5 years, 38% of the tax bill is devoted to renewing the 2017 tax cuts. Over a 10-year period, that quotient jumps up to 58%. So the biggest lift in this bill is renewing the 2017 tax cuts.
Why not just take that out? And I know that's kind of a dumb question because I know why it's in there. But at the end of the day, do we need that type of stimulus in the economy? Isn't this a time where maybe if you were going to tighten the belts a little bit, you can take advantage of it in this particular environment?
I would imagine some of those five who voted against the legislation today in the Budget Committee feel that way. It's not at all a dumb question. The question I think markets are asking is, at what point does Washington get serious about fiscal consolidation, even if it's a little bit? If we get to January 1st of next year and there's no legislation to renew the tax cuts, and presuming it doesn't come later and make those tax cuts renewed retroactively, over the following 2 fiscal years, nearly $5 trillion comes back to the Treasury. That's a pretty quick way to cut into the growth of deficits and debt. I would imagine that there are more than just 5 Republicans who are aware of that. There's a lot of work to be done. This bill has never had broad support. It has missed several soft deadlines. Today was another soft deadline, but the calendar continues to churn. Yeah. The real concern, of course, is what they do about debt ceiling. They'll either need to do that in reconciliation, and they can raise it by a number specific, or they have to pull it out and further suspend it to another date, which would require 60 votes in the Senate and obviously negotiation with Democrats, something Republicans would hope to avoid.
Certainly so. I am curious about the potential political risk of all this because they're kind of bumping up against 2 things. Sort of the rank and file voters who might look at potential cuts in certain programs as being an assault on their lifestyles. And at the same time, you have financial markets and Wall Street that, of course, are concerned about long-term structural issues when it comes to the deficit and debt servicing and how that could feed through. And I am curious if that comes to a head. I mean, can they actually address both of those issues, or is Mike Johnson and the Republicans just going to effectively just kind of have to pick, one master, I guess, to satisfy?
My sense, Romaine, is that they thought that they could, or if they had a formula for addressing both of those concerns, which are mutually exclusive, we would know it by now and they would have voted it. It's very difficult. It's part of the obstacle to moving forward that will, at least in my view, prolong the discussion on fiscal policy so that legislation reaching the president by this summer, anytime before the August break, became much more remote early this afternoon.
All right, Kim Wallace, head of Washington Policy Research at 22V Research. I would wish you a good weekend, but you might actually be working on Sunday, as the latest news here is that the House Budget Committee will take another stab at this on Sunday down in Washington. Meanwhile, coming up here on the big program, we're going to talk AI, a conversation coming up with Matt Wood, the CTIO over at PwC. A new report out on these AI agents and how they're being implemented by organizations. The data might actually surprise you. That's coming up next here on The Close on Bloomberg. There's a great read on the Bloomberg terminal today about the CEO of Microsoft, the world's most valuable company, and its push deeper into AI. The company has already invested almost $14 billion with OpenAI and plans to spend an additional $80 billion on AI data centers in this fiscal year alone, as it really looks to try to get out ahead in this global AI arms race. And a big component of that is Agentic AI. And there's a new study out on that from PwC that shows that 88% of companies out there plan to increase their AI-related budgets over the next 12 months, with most planning increases in the 10 to 25% range. Here to discuss that report is one of the people behind it. Matt Wood joins us right now. He's a CTIO over at PwC. And Matt, it's kind of interesting here. I mean, 88%, I guess I'm not surprised by that. I guess the question is, how targeted is this spending right now? Any way to quantify that?
Well, I think what we're seeing is that every organization that we speak to in every industry is making investments, deliberate investments into their AI strategy, and a big proportion of that is going towards their agentic or agents that are operating inside their organizations. I think what is interesting and maybe a little counterintuitive is that the organizations that are actually moving fastest are those in the regulated industry space. So financial services, insurance, manufacturing, healthcare, life sciences. A lot of these organizations that have had to make progress with compliance and assurance over time, that compliance and that regulation has actually driven the right set of behaviors around data quality and data privacy to be able to make the AI piece actually a relatively easy and light lift. And that's why we're seeing those organizations that have already gone through that process moving more quickly with their agentic workloads. And
just to be clear, I mean, just for our viewers, so when we talk about agentic AI, we're not just talking about, a chat bot that we just feed something into it and it gives us an answer. It's the idea that it's not only giving us that information, but in theory, then able to act on that information in some way that's appropriate to the organization, correct?
Yeah, that's right. I'm sure we've all played with something like ChatGPT, where you can ask it a question and get answers. It's a very useful tool. Agents take that a step further. So instead of just asking a question and getting an answer, you set the agent an objective. And the agent understands that objective. It creates a to-do list of things that it needs to do to complete that objective. And then it diligently works through that to-do list, executing against the plan step by step, until it either finishes or learns something new. And if it learns something new but hasn't finished its task, it goes back to the beginning and starts the process again. So over time, they get better and better at understanding the tasks that they need to fulfill, and they get more and more capable. And what's really interesting about agents today is that they're one of the best ways that we know how to allow organizations that are large, enterprises, to be able to scale their AI investments. Yeah. Because agents don't just solve problems, agents can work with other agents to solve more complicated problems than any agent can on its own.
Do you have any sense of what the uptake is within these organizations? I mean, we say, okay, 88% are spending more money on this, but within those organizations, I mean, how many of those employees, what share of those employees are actively using these agentic AI platforms?
It's a really great question. It obviously varies. I think the average today is probably between a half and 2/3. But in certain areas, the numbers will be much, much higher. So as an example, we were doing some work recently with Wyndham, the hotel chain, and they were able to use agents to be able to drive forward their customer service. So they have a federated model, and they drive customer service using their agents, which not only allows them to reduce their costs of delivering customer service, but also led to an increase in customer satisfaction. And so customer support is one critical area. Another one that, again, is maybe a little counterintuitive is software engineering. These agents are remarkable coding companions. They're able to understand the type of application that you want to build and then write the majority of the code in order to be able to either get you started or or in some cases, complete the application totally.
And so the cost to do this, though, you're saying that it is a cost effective, because I know there was some concern over the last couple of years as companies started to adopt some of these AI tools, is that, it still costs a lot to run these things. So, yeah, you may get some productivity benefits, but not necessarily financial benefits. Has that been addressed?
Yeah, I think that's probably the case. A lot of people talk about efficiency and efficiency gains, and there's certainly a large amount of that you can generate. Usually, you should expect to get about 20 to 30% efficiency, but the real accelerant is that AI agents are amplifiers of existing skills. They are amplifiers of your existing talent, and so agents don't replace your need to write. They make you a better writer. They don't replace your need to solve problems, but they make you a better problem solver. And so where you have existing talent inside your organization that you want to amplify, agents are a really good way to do that. You get a higher return on your investment, and you tend to actually invest more where you see higher returns. And so as a result, again, counterintuitively, you actually end up spending more because you're getting more growth and return from the areas where agents are most successful.
And so just real quickly, so then the amount of money we're seeing spent on it this year, you expect that, PwC expects that to continue to grow?
Yeah, absolutely.
All right, Matt, great stuff and a really fascinating report. Matt Wood, he's the CTIO over at PwC. They have a great report out today here on the adoption of AI, specifically agentic AI, and the amount of money that a lot of those companies are spending on it. We want to push ahead to next week. We are going to get a lot of earnings from the retail sector. We want to focus on that with Wendy Liebmann of WSL Strategic Retail and with Naveen Jaggi over at JLL. That conversation, both of those conversations, coming up after the break, right here on The Close on Bloomberg. All right, we learned earlier today that U.S. consumer sentiment is nearing a record low, largely because of inflation concerns. Now, this data point comes ahead of a week full of retail reports, earnings reports, from names like Home Depot, Target, Ross Stores, Deckers, and others. Joining us right now to discuss is Wendy Liebmann. She's the CEO and chief shopper at WSL Strategic Retail. Wendy, great to talk to you once again here. And I do want to start off with that report we got this morning, because it's not only just about consumer sentiment overall being dour, but it's very dour specifically when it comes to the cost of goods, as well as people's perceptions of their financial situation and their job security. And I am curious that when you start to see those sentiment numbers come down, does that translate directly into shoppers pulling back?
It does indeed. I mean, you've got two things going on. One is, you say, sentiment. It's also people saying, I'm uncertain. So uncertain about the future means people either sit on their hands and their wallets until they are more certain, or they just keep shopping more frugally, lower price places, fewer things that they don't have to have, so more essentials versus nice to have. And they really sort of shrink their mindset, shrink their trips, and just become much more cautious. And that's the situation we're in right now.
Well, that's kind of interesting, too, because a lot of some of the names that we're going to report next week, I think to a certain extent, we kind of fall into that quote-unquote value space, TJX, of course, being one of the bigger ones. And I am curious as to what you expect. I mean, do they, when times get tough and people get scared, the idea is that they're not going to completely retrench. They may keep buying, but they are going to search out something lower cost. TJX is a beneficiary of that?
Yes, indeed. That's where people say, I still need things for the kids, for school. I need things, or summer. I need things, I don't fit into my pants anymore or something. And so they can say, where do I go that I trust the quality, but it's a better price? It's also a little place where I can get some little treats. I can get my hair care things. I can get my home things. So a retailer like TJX, with their variety of offer in different banners, really is a safe haven for people in these kinds of times.
On the other end of that spectrum is Target, which I always thought was kind of a value play, but apparently not. I know they've got some idiosyncratic issues, but can they not also benefit in the same way as TJX?
One of the challenges Target has had is this expectation of, I go there, I'll always be surprised. So even though it's less expensive than other places, I may end up spending more. As you suggested, they've got other issues at the moment they're dealing with when it comes to the traffic going to the stores. But that notion of I'll go with a shopping list of these things, but I'll find some other great things and I'll spend more, is the thing that creates a problem for Target in these times. Now, they're being quite aggressive right this moment with a lot of promotion, figuring out big summer promotion they've got, and that's their way of saying, listen, still come to us. We've got great prices, lots of things under $20, and we are a place for you in these times. But when it comes to everyday essentials, that's not necessarily where they go because they could be too tempted to spend.
But do these retailers have that sort of capacity to, I guess, offer more discounts? And I bring that up because we had Walmart report earlier this week, and they kind of made it clear prices were going to have to come up for the consumer. Now, it'll probably be very targeted and limited, but the idea that a company like Walmart that basically kind of sets the tone for value-based shoppers is saying that I would think these other companies are going to be in the same boat.
Absolutely. I mean, I thought that was an extraordinary announcement because we all know Walmart, as amazing as it is, they're very cautious about taking price increases. And for them to say that after, and announce that between themselves and their supplier community, they just couldn't absorb all the tariff increases and that their shoppers won't be able to absorb them. But so they will be sparing on where they go and where they bring the increases in. But, for the Walmart shopper, which is most of the country in many ways, it's a problem. And so for Walmart to say that means, that's going to be an issue for a lot of the retailers we're talking about, even the value-oriented retailers.
I want to get your thoughts, though, on a completely different kind of retailer, and that's going to be Home Depot. Lowe's also reporting next week as well. Obviously, sort of a completely different category. I mean, it could be discretionary. It could be more of a necessity, depending on, I guess, what your house looks like right now. But how do they hold up when times get tough? Do people pull back on those sort of home improvement projects? Or maybe in an economic downturn, that's all you got to hang your hat on?
Well, that's it. I mean, there are things you think about, right? Sometimes they are essentials. The winter's over, you've got things you need to do. And if you're used to get somebody else to do them for you, if you're fortunate enough, now you've got to do them yourself. If you've got to do a bit of painting, that's where you go. If you've got to just, spruce the house up to make sure everything's fine, air conditioning, all of those things, if you can afford those, that's where you go. So it's more the trade-off as opposed to the trade out when it comes to the home, home retailers like Home Depot or Lowe's. It's often a fail safe when things are tough. You've got to do more of it yourself, and that's the perfect place for them.
Quick question before I let you go, Wendy, and this is really on the high end of the spectrum, and we don't get any of those earnings next week, but we got a few of the European luxury makers have already reported, including Richemont this week and LVMH last week. And it seemed to be that there is a little bit more resiliency there, although there was a bit of a pullback. And I am curious that if people have the means to spend and times are bad, do they still pull back?
Actually, often they do. And it's a combination of pulling back and or wanting to be smart shoppers. They've got money because they know how to spend. And so sometimes they will find less expensive places to go, or they'll just hold back for the moment. So again, that caution has an impact on luxury categories as well. If I don't need it right now, maybe I'll wait a month, see what happens to the stock market, see what this craziness of news cycle is doing for us. So, you're going to see the same thing there. It'll be, they've got the money, but that doesn't necessarily mean they're going to spend it.
All right, Wendy, great stuff. Wendy Liebmann, CEO and Chief Shopper at WSL Strategic Retail, as we focus in on some of those retail and apparel earnings set to cross the wire next week. And our next guest is actually looking at this from the perspective of real estate. He says that for the first time in 16 quarters, more retail space is being vacated than is being occupied. He cites almost 10,000 closures between 2024 and early this year. Joining us right now is Naveen Jaggi. He's president of Retail Advisory Services at JLL. All right, let's talk about these closures, because I remember at the end of last year seeing kind of some of the statistics of how many closures, individual store closures we have. And I am curious as to whether these creates a retail opportunity or we should be reading into this something a little bit more negative about all of these vacancies.
So it's a great question. And I think the answer is, for the most part, it's an opportunity for a lot of retailers to pick up space that they've been limited in having. We're still at historic lows when it comes to retail supply in the major markets across the USA. So when you see a Joann's closing up, or a Party City, or a Bed Bath & Beyond last year, and others, this is really actually good news for most owners, most investors, and most occupiers, because it takes opportunity for many retailers to take space they just haven't been able to get to for the last 2 to 3 years. So in the near term, this is really good news.
Are you expecting to see more closures this year? I mean, meaning a higher number of closures in 2024?
Not expecting any more announcements. I think all the announcements we saw over the last 3 or 4 months were ones that we've been anticipating. Most of these retailers have been on a watch list. Joann's filing bankruptcy twice in 12 months is one good example. Rite Aid announcing a bankruptcy recently has been something forthcoming for the better part of 12 to 18 months. So the closures that we've heard about didn't catch anybody by much surprise. Don't expect anything else more announced until at least probably the next year, and we'll have to see how that plays out relative to the tariffs impact in the near term.
I'm glad you brought up the tariffs because we came into this year and it seemed like you pick an industry, you pick a sector, there was relative optimism. And of course, a lot of that got upended by the time we got to February and March when a lot of the tariff talk started to bubble up. I am curious if that creates some stasis here, because if you are a company, a retailer, and you said, okay, we're going to open 25 stores this year, and then you saw what transpired over the first 3.5, 4 months of this year, does that get put on ice? Or do you say maybe instead of the 25, I'll do 10 or 15?
You'll likely not put it on ice. What you'll likely do is pause. I mean, what we've seen, remember, we saw the tariff talks started back in November during the election. We also saw tariffs talked back in February and March during the Canada and Mexico tariff talks. All those were reversed pretty quickly. Now we had tariff talks when we have Liberation Day, and what happened 3 weeks later? Those tariffs were pulled back. So in general, the consensus is let's pause, let's wait, let's see, let's not stop. Retailers have to show growth, and they show growth organically through sales or through new store openings. So in this environment, it's not about stopping store growth, it's about pausing to watch what's happening in the environment. I don't see this as long lasting, by the way. I'm a big believer that at the end of the day, the U.S. consumer is very resilient. They will continue to shop, and when they shop, retailers will deliver those stores for those consumers.
As these properties come on to the market, I am curious as to how long they're staying there. Is this like, okay, it's going to sit for a year before somebody buys it, or is this stuff being snapped up in a matter of weeks?
It's being snapped up in a matter of weeks, if not days. Some of the most aggressive retailers in America today, Dollar General being one, Burlington being another, TJX, Ross, Dress for Less, by the way, all value-driven retailers, have been very aggressively taking these spots to the tune of between 50, 60, 70, and 100 of these spots. So I think the value sector is the biggest beneficiary of these openings that have become available. I think consumer finds more optionality as they see these value retailers taking more and more space.
Is there a major geographic difference in where we're seeing the vacancies, but more importantly, which ones would be bought up prior to the others?
Well, they've used the term sunshine states or the small states has been a common term in the past. And I think for us, seeing the Southwest, the Southeast, all the way through Arizona and California, continue to be the biggest markets for growth and the biggest markets for opportunity. Not to mention that's where we've seen household growth, and we've seen more homes and more people moving to those homes in the Southeast and Southwest. So if I'm looking at any part of the geography of the U.S. that seems most attractive for retailer growth, it's in the sunshine states.
You know, Naveen, for the first time in probably years, I was actually in a mall about a week and a half ago. It was a pretty sad affair, to be mind you. There was a lot of vacancies in there. They still had a couple of the big anchors. I am curious about the traditional indoor mall that kind of, defined, at least for me, my childhood and a lot of others here, as to whether that is kind of a thing of the past or whether there is some sort of resurrection or reimagining of that space that could actually benefit everyone.
Well, that's a great question. I was actually in the Houston Gallery this past weekend for Mother's Day. And what struck me so much about that experience was that in almost every major luxury brand, I saw a line outside the door to get in. So I think the answer is, if you're in a Class A mall or a major top 30, 40 city, the mall is still going to be here 50 years from now. Now, if you're in a secondary or tertiary city where you're over-malled, where you're overbuilt, yeah, there literally isn't a place for that second or third or fourth mall in that community. As we've been saying in our sector for quite a while, we're not over-malled, actually. We're probably under-demolished, and we need to take some of these malls away. But the mall as an actual anchor in the community is still an important play. I don't see the malls going away. I just see bad malls going away.
This is a trick question I'm going to give you, Naveen. If you were starting a new project today from scratch, I mean, what would it look like? Is it going to be more heavily weighted towards luxury brands? Is it going to be more heavily weighted toward like services, like restaurants and gaming and things like that? I mean, how would you structure it?
Well, look, the number one asset class where America shops today is the grocery anchored shopping center. That's where they shop every day. And what you're seeing in that shopping center today is a transformation. It used to be that it was filled with some F&B, food and beverage, and some service retail. Today you're seeing the biggest retailers in America, whether it's beauty aids like Ulta or Sephora, or fashion like Levi's, or exercise like Planet Fitness, et cetera, taking those spaces up. I think that's where I would put my money as a grocery-anchored shopping center.
Hey, Naveen, we got to leave it there. Really appreciate it. Naveen Jaggi, President of Retail Advisory Services at JLL. Breaking news crossing the Bloomberg terminal right now. The credit rating for the United States government has been downgraded by Moody's, cut to AA1 from AAA here, just to be clear. Let me just double check that. Moody's rating is downgrading the United States to AA1 from AAA. Remember, there's a big budget battle going on in Washington right now. A lot of folks have been talking about this idea of addressing the U.S. budget deficit. A tax bill working its way through Congress would extend the Trump tax cuts that were put into place back in 2017. At least 5 conservative Republicans voted against that bill in committee earlier today, primarily because of their concerns about how it would add to the debt servicing levels. Remember, a debt to GDP level right now at about 120% that would go up, at least based on CBO estimates, to 125% on the back of it. And now at least one of the ratings companies has weighed in. We're going to try to get you some more details, but the redhead crossing the wire is that Moody's has downgraded the United States credit rating from AAA to AA1. We'll be back in a moment. We spent this hour talking about economic conditions, particularly when it comes to the consumers. A lot of price hikes rattling that consumer, with companies like Walmart saying they might actually have to raise prices on them. But in the face of this economic uncertainty, our next guest says they provide a, quote, recession-proof service. I'm joined right now by a woman named Rachel Liverman. She's the CEO and founder of Glowbar, which does facials, fast facials, in 30 minutes or less. And I love this concept of having a recession-proof business, because there's always this talk about this idea that when times get tough, there are certain things people don't cut back on, such as like the little luxuries, whether it's, beauty products or getting a facial or some other sort of a personal beauty service.
Yeah. Glowbar is the first to market 30-minute facial membership. And what we've seen is that there is no consumer slowdown in effective, affordable facials. And we're really, really excited to see that.
You've kept this at pretty much like a set menu, more or less. It's basically one thing, one price, more or less. I know there's some, you have other products and stuff as well. But there's a simplicity to it that differs from some of the pricing models that your competitors have. Why did you choose that?
I was really frustrated as a consumer with the offerings that existed. And I wanted something that was really clear to me. I knew from my decade in beauty and 3 generations of skincare behind me, with my grandmother and my mom pioneering skincare, that I needed to create something for the modern day consumer like myself. And as that, I wanted a simple business model. I didn't want a menu. I didn't want to be caught with add-ons at the end that added price to what I already committed to as a surprise. No consumer likes surprises. And I really just wanted something that I knew what I was signing up for, and I was going to get just that. And so Glowbar is just a 30-minute facial. How confident, though, were you in it? Because, I think about, particularly in New York City, I remember it was like in Dry Bar, which is where you get a fast blowout of your hair. Obviously, not for me, but for those who have long hair. But it seemed like one day I'd never heard of them, and all of a sudden, boom, they were like in every neighborhood in New York. You came along in 2019, right? Exactly. Did you look to places like Dry Bar as potentially a model for what you were doing? Exactly. So Allie Webb, the founder of Dry Bar, is actually on our advisory board. She was my first phone call. I called her and I said, I have an idea for a skincare business that's likened to Dry Bar, and I love what you're doing, and I need you to know I'm going to launch a company called Glowbar, and I own the trademark, and I would like you to buy me one day. Wow. And she said, I'm not going to buy you necessarily. You haven't even proved your concept yet. But I love it. Go forward, and I'm here to help you. And she has the entire time. So Dry Bar was, of course, a great inspiration for me. You started this in 2019. You have a business where people have to physically come in and someone stands over them and rubs their face, more or less. Yes. The pandemic hit in 2020, where I don't think you were allowed to stand over anybody and rub anyone's face. How did you handle that? That you start this business and within a year, you effectively have to at least shut it down temporarily. Yeah, so the pandemic was my first test of entrepreneurship. It was not part of my business plan, and like my father says, man plans and God God laughs. And so what did we do? We pivoted like everyone else, and humans are resilient. And what I always believed in my core from my family and watching them go through economic downturns in the 30 years that I watched my family own skincare companies was that the human being is resilient, and humans want physical one-to-one experiences. We are social beings, and I've just believed that in my business always, and I still do. And so I just got through those 7 months of closure believing that the second we opened our doors and the government told us we could, that the consumers would be coming back in. And today we're the largest facial membership in the world. And so I think we've proven that over the past 5 years.
So how many locations do you have right now?
We have 19 open. We'll have a few more this year.
And where are they located geographically?
So Eastern region. So everywhere from DC up to Boston.
And your plan is to open how many?
As many as I can.
Do you actively have things in the works right now in terms of locations and stuff?
Always. We always have about 10 in the works.
Are you finding, I guess, real estate value right now? I mean, we were talking with our previous guest who actually says with a lot of the retail store closures, that's actually creating some opportunity for those companies that are expanding in the retail space.
We find great value. And I mean, the COVID was my best values that I found. No one else was signing leases. And I was like, ooh, what can I, sign today? I think everyone's really excited about the brick and mortar retail space. So we're finding great deals.
All right, Rachel, this is great. We have to get you back on to talk a little bit longer about this, but you have a great backstory. And you mentioned, of course, you're a multi-generation beauty experts there. Now, Rachel Liverman's making her own mark as the founder of Glowbar. All right, we do need to get back to that breaking news just a little while ago. The United States foreign issuer rating downgraded by Moody's to AA1 from AAA. Michael McKee, our Bloomberg international economics correspondent, joining us right now to talk a little bit more about this. I'm not surprised this happened. I'm surprised this is happening now. Mike, what do we know?
I would agree with you because this has been talked about for some time as a possibility. Moody's was the last of the three major rating agencies to take this step, S&P back in 2011. It may not mean a whole lot in terms of the markets. There could be some portfolio rebalancing based on this, but most contracts say reference U.S. government debt rather than specific ratings for it. So that could prevent forced selling. However, it does mean likely higher interest rates. We'll have to keep an eye on the yield curve, and that raises the costs that the U.S. government is going to have to pay to service its debts.
This gets to a question, too, because I know, Scott Bessent has really been making the rounds as of late, mostly to talk about some of the trade issues. But he was also really kind of communicating about some of the issues going on with the Treasury Department, its debt load, how much Treasury debt it would have to issue, and how the deficit and the debt played into all of that. Did he take into this account, at least publicly, did he actually address any of these particular issues with regards to the potential for a downgrade?
He hasn't really been asked about the potential for a downgrade. There have been a lot of questions about Treasury issuance and certainly about the cost of servicing the debt. But this had sort of faded. The government has been in a massive debt profile for quite some time. And I think we could all agree Congress has shown no interest in doing anything about it. And so there had been talk over the last several years that perhaps Moody's would come out, especially when we have the debt ceiling standoffs, and go ahead and join the other two, Fitch and S&P, in downgrading the U.S. But it had sort of faded over the last year or so. I haven't heard as much about it, but it's always been hanging out there. And now we finally see Moody's going through with it. It will be the real question is, how are bond holders going to react to this? How much is it going to change interest rates?
Yeah, absolutely. Here, Michael McKee, thanks for jumping on. We want to keep the conversation going right now and go to Kelly Lyons, the co-host of Bloomberg's Balance of Power, with the big headline, Kelly, of course, that Moody's has downgraded the United States to AA1, specifically citing government debt and interest rate payments, also saying that it expects that the federal debt burden will rise to 134% of GDP by 2035. Interesting, too, that this comes on a day where the House Republicans are trying to push through a big tax cut bill.
Well, a tax cut bill, Romaine, that could add trillions of dollars to the deficit over the next decade. And as conservatives argue that this bill does not do enough to cut spending to offset some of those effects. And there is a call out from Moody's here about the current policy proposals working their way through Washington. They say in the statement, we do not believe that material multi-year reductions in mandatory spending and deficits will result from the current fiscal proposals under consideration. So despite Republican efforts to find savings in areas like Medicaid, with the extension of the 2017 tax cuts, all of the other tax policy that they're trying to pursue, that all could be deficit additive to the tune of $4+ trillion. And that is really what Moody's is taking consideration here. This could actually add fuel, Romaine, to the argument some of these fiscal hawks in Congress are making that this bill should not pass as is because of the impact on the debt and deficit, keeping in mind that Moody's was the last one standing when it comes to having the highest rating on the U.S.
We'll talk about that last point you made. So we had a House committee vote today where this reconciliation bill failed. 5 Republicans broke ranks, joined with the Democrats, and those 5 Republicans specifically were calling out these long-term debt issues as one of the reasons why they would not vote for it. I assume they have to be pretty happy right now because they've got a big piece of ammunition heading into this next vote, which I think might be on Sunday. Is that correct?
Yeah, the Budget Committee is going to try again at 10 p.m. Sunday, and this does add fuel to their argument and perhaps make more complicated the Speaker of the House's negotiations with these members that he intends to conduct throughout the weekend. It really is just 4 holdouts remain. The 5th no vote was for procedural reasons so that this can be brought back up. But for the likes of Congressman Chip Roy or Ralph Norman, who have been talking about this, they say that this bill is punting the actual pain of reducing the deficit and cutting spending until too late, as Medicaid cuts, for example, for those who need work requirements in this legislation don't kick in until 2029. They say it needs to happen much earlier than that with the fiscal health of the United States in mind.
All right, Kelly, we'll let you get back to it. Kelly Lyons is a co-host of Balance of Power. You want to stick around. Her show starts at the top of the hour. They're going to have a lot more coverage on this here. A very consequential decision by Moody's to lower the credit rating, the issuer rating on the United States government to AA1 from AAA, now joining S&P and Fitch, and having a rating below that AAA level here, specifically citing increasing debt loads, increasing services costs, and the potential for a slowdown in GDP. That does it for the close. Balance of Power is up next, right here on Bloomberg.